I made a huge mistake when I bought my first business. I didn't read the contracts thoroughly enough. I didn't verify where the revenue was coming from, the concentration, and I let a little bit of emotion in there. That FOMO stuff, fear of missing out. That pushed me into a deal I didn't fully understand. I thought I was buying a real cash flow asset. What I bought was a very expensive lesson. So in this video, I'm going to walk you through exact skills every business buyer needs to master before they pull the trigger. This is the difference between making a smart investment and buying yourself a full-time headache. Hi, I'm John Stoddard. I've helped close $33 million in deals and raised $50 million in capital, bought, grown, and sold a couple businesses. Now I coach first-time buyers on how to do it right the first time. Let's talk about the 5 core skills that will save you time, money, and pain when buying a business. Number 1, mastering due diligence. Most people think they're doing due diligence, but they're really just glancing at the P&L and taking the seller's word for it. Real due diligence means you got to dig into the tax returns, the QuickBooks files, the bank statements, and look at the trends, not just a single year. Are sales declining? Are margins getting squeezed? Are they on cash or accrual accounting? Are the books clean? Are they balanced? Are the personal expenses buried in the P&L? What about add backs? Can you verify them? Are they real? Are they one time, non reoccurring, or are they propping up a weak cash flow? Let's talk about legal and regulatory, UCC filings, contract liabilities, outstanding debt, IRS liens, employee disagreements or agreements. Let's take a look at operations. Who are the key employees? And what happens if that main person quits? What about the market? Is the business trending up or headed for disruption with AI? And let's be real, you're not doing this alone. Hire a CPA, hire a small business M&A attorney. Use AI if you want to speed up the pattern recognition, but always verify. Due diligence is where good deals are confirmed and the bad ones are dodged. Number 2, strategic negotiation. Here's when most first-time buyers choke. They focus on price, but what actually matters is terms. Would you rather pay $900K in all cash or $1.2 million with 10% down, 10% seller financing, and 12 months of transition support? Understand the seller's motivation. Are they burned out? Are they moving? Are they getting a divorce? Or just tired? When you know what they want, you can structure creative terms. Holdbacks, earn out, seller notes, asset versus stock sales. Also, never negotiate from emotion. It's business. Use the leverage you have. Use comps, use logic. This deal is like a puzzle, and you're solving for both sides. Number 3, post integration. Most buyers think, I just need to close. Just move it forward. But closing is day 1. It's not the finish line, it's the starting line. You need a 30, 60, 90-day plan before the ink dries. Don't make any big changes in the first 6 months. Key points: meet the team, build trust fast, communicate with customers if needed, especially if it's a service business. Don't change too much. Some people use 6 months, some people use 12 months. Don't make massive changes. Understand every moving part: inventory, accounts receivable, vendors, and systems. You want continuity, not the chaos of big changes, because you don't have your sea legs yet. In one of my acquisitions, we kept the seller involved for 90 days. He made intros, smoothed over the questions, and helped us avoid rookie mistakes. That was a good transition, and we had a profitable first year. Number 4, financial management and growth. This is where buyers either scale or stall. After close, you need to be obsessed with these numbers. Cash flow. Are you staying ahead of payables or debt service? Margins. Are you tracking product service profitability and weekly? Debt service coverage ratio. Especially if you use the SBA or outside investors, you need to monitor debt coverage constantly. And unit level economics. This is kind of a PE term, but what did it take to get you to your first million? That's how you duplicate it next. Use dashboards, use AI, use a fractional CFO. There's a lot of them out there now. If you're not a numbers person, then plan for growth. Can you raise prices? Can you upsell anything? Can you cross sell? Can you reduce churn? Can you cut back on expenses? Can you acquire a competitor? You just bought a machine. Now it's time to tune it up. So, number 5, long-term vision and leadership. Buying a business isn't just about the financials. It's about leadership. Here's what that means. People need to believe in you, the employees, the customers, and the partners. You need to cast your vision and then deliver on it. Build culture, build systems, build something that runs without you. Otherwise, you didn't buy freedom, you bought a job. You're not just an investor, you're the leader now. So act like it. Now, let me rapid fire a few common mistakes. Number 1, don't trust the broker sims at face value. Always verify. Number 2, don't skip the site visit. See the operations, smell the business, just take it all in. Number 3, don't fall in love with the first deal. Run on 15 to 20 reps minimum. That means looking at 15 to 20 good deals. Don't go it alone. Get coaching, get guidance. You don't know what you don't know. So if this helped and you want a real step-by-step on buying your first business the right way, grab my book. It's just $19.99 and packed with the exact framework I've used to help first-time buyers close million-dollar deals. You'll find the link down below. I'm John Stoddard. Thanks for watching. I'll see you on the next one.